When it comes to investing, you've really got one fundamental choice to make. Are you going to try and outsmart the market, or are you just going to go along for the ride? Well, that's the core difference between active and passive investing, and we're about to break it all down for you.
Right, so that one decision, to beat the market or to match it, pretty much defines two completely different philosophies for how to invest. Now, there's no single right answer here, but by the end of this, you'll have a really clear way to think about which approach makes the most sense for you and your goals.
So, first things first. Let's just get the definition straight. What are we actually talking about when we say active versus passive? Okay, when you boil it all down, it's actually this simple. Active investing is all about trying to beat the market's average performance. Passive investing, it has a totally different goal, to just track and match whatever the market does.
So active investing is exactly what it sounds like. It's a very hands-on approach. You've got a fund manager, or maybe it's you, making specific calls to buy this stock or sell that bond. And the whole point, the entire goal, is to do better than a market benchmark, like the S&P 500. You're basically betting that your picks are going to outperform the average.
And then you've got passive investing. This is the complete opposite. It's the hands-off strategy. Instead of trying to find that one needle in the haystack, you just buy the whole haystack. You're not trying to pick winners, you're just buying a little piece of everything, like all 500 stocks in the S&P 500, to mirror how the index performs. Your goal isn't to beat the market, it's to be the market.
So how do active investors actually try to do it? How do they aim to win and beat the market? Let's take a look at the process.
The active process, it's a grind. It kicks off with really deep research into companies, economies, you name it. That leads to constant analysis of market trends and financial reports. And based on all that work, managers are frequently buying and selling, always trying to find an edge. It's a high-effort game, for sure.
Now, for most people, this doesn't mean you're sitting at a desk trading stocks all day. The most common way to get into active investing is through a professionally managed fund, like a mutual fund. You're basically paying an expert to do all that research and trading on your behalf.
Okay, let's flip over to the other side of the coin, the passive approach. What does just tracking an index actually look like?
The tools for passive investing are built for simplicity. The ones you'll hear about most are index funds and exchange-traded funds, or ETFs. These funds are designed to do one thing: hold all the stocks in a particular index. It's a way to automatically get a diversified slice of the entire market.
And one of the biggest, and I mean biggest, arguments for passive investing really comes down to a single word: cost. Because you don't have a big team of analysts and traders constantly making moves, these funds are just way, way cheaper to run. And the difference in fees is pretty shocking. An active fund could easily charge you 1%, maybe more, of your investment every single year. A passive fund, we're talking a tiny fraction of that. Now, 1% might not sound like a lot, but just think about this. Over 30 years, that 1% fee can eat up nearly 30% of your final returns. That's a huge piece of your nest egg just gone.
All right, so we've got two very different strategies. One is high effort, high cost, and it's chasing those higher returns. The other is low effort, low cost, and it's happy with just getting the market return. So let's put them side by side.
So here's the breakdown. With active investing, you've got the potential to beat the market, sure, but it comes with higher costs and the very real risk that you'll actually do worse. With passive investing, you get those lower fees and predictable returns, but by its very definition, you're never going to beat the market average. It's really that classic trade-off between potential, cost, and risk.
But here's the thing. It doesn't have to be an all-or-nothing choice. You don't have to pick a side and stick with it forever. In fact, a lot of smart investors actually find a way to get the best of both worlds.
There's this really popular strategy called the core and satellite approach. The idea is pretty simple. You build a majority of your portfolio, that's your core, with low-cost, diversified, passive funds. That gives you a really stable foundation for long-term growth. For instance, you might put 80% of your money into a passive core. And then, with that other 20%, your satellites, you can make some active bets on specific stocks or funds that you really believe in. It gives you the stability of passive investing with the potential upside of active.
Okay, we've covered a lot of ground, so let's just pull it all together. What are the most important things to remember from all this?
First off, just remember the fundamental goal. Active wants to beat the market, passive wants to match it.
Second, active investing is just more expensive, both in fees and in the effort it takes. Third, passive investing gives you predictable market average results for a much lower price. And finally, and this is probably the most important part, the best strategy is simply the one that fits your own personal goals, your time horizon, and how you feel about costs.
So the question really comes back to you. Are you looking for that chance to outperform, and you're okay with the higher risks and costs? Or do you just want a simple, low-cost way to grow your wealth right alongside the market? Which of those paths really aligns with your financial goals?